Do you want to beat the vast majority of professional investors? Do you want to know the secret of Buffett's will to his wife? Do you want to be free from the futile effort of trying to beat the market? The answer is simple. Don't try to beat the market. Become the market. Why does it work? This slide explains it all. Warren Buffett, the world's greatest investor. The will he revealed in his 2013 letter, My Will. His instructions to his wife are clear. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. Do you notice the critical pattern here? Buffett himself is a genius at picking individual stocks, but he doesn't recommend individual stocks to his wife. Index funds. This is a fact proven by decades of financial research, not a hypothesis. An established mechanism that even professionals can't beat the market, and this is achievable. Buy an S&P 500 index fund. Choose an ultra-low-cost one. This way, you beat the vast majority of professionals. Today, I'll show you the mathematical foundation. Professional investors. They've been trained for years. They have MBAs, stare at Bloomberg, analyze companies. But after 15 years, about 88% of them lose to the S&P 500. This is not coincidence. It's a statistical fact shown by the latest SPIVA data. In the short term, about half win. But the longer the period, the lower the probability of beating the market. After 15 years, about 88% are defeated. Why? Their opponents are also professionals. As professionals fight each other, they consistently fall short of average by the amount of fees. This is the mathematics of a zero-sum game. Do you think you're better than professionals? The data says you're not. Let me show you the numbers. This is a calculation example assuming an 8% annual return. While future returns aren't guaranteed, the principle that cost differences compound applies generally. Invest $100,000 for 40 years. Index fund cost is 0.05% annually. Real return, 7.95%. High-cost active fund cost is 1.5% annually. Real return, 6.5%. After 40 years, the index becomes about $2, 136,000. Active becomes about $1, 241,000. The difference, about $895,000. What is this difference? Not your investment judgment, not the fund manager's ability, just cost. An annual difference of 1.45%. But with 40 years of compounding, it creates a difference of about $895,000. This is the dark side of compounding. High costs quietly erode your wealth continuously. The market is unpredictable in the short term. In 2008, the S&P 500 was minus 37%. The next year, plus 26%. But what happens when you look at the long term? The S&P 500 Total Return Index with dividends fluctuates from minus 37% to plus 32% in the short term. But in the long term, it historically tends to settle within a certain range. More importantly, there's no guarantee that funds that win this year will win next year. Research shows limited examples of active fund outperformance continuing. So don't try to time the market. Stay in the market. That's the only way to win. Even in the 2024 market, a small number of giant tech companies drove profits. Accurately predicting and holding these is extremely difficult, even for professionals. That's why index funds that buy the entire market win. Index investing has 3 advantages. First, ultra-low cost. About 0.03% to 0.10% annually. 1/7 to 1/20 of high-cost active funds. If you invest $100,000 for 40 years, this difference alone creates hundreds of thousands to nearly $1 million in difference. Second, broad diversification. With the S&P 500, you're diversified across 500 large U.S. companies. It absorbs the bankruptcy risk of individual companies. But caution is needed. The S&P 500 is market cap weighted, so weight tends to concentrate in the top giant companies. It's not perfectly equal. If you want stronger diversification, the concept of combining global equity indexes and bonds is also important. Third, bet on market growth. The S&P 500 offers broad diversification across large U.S. stocks, and while U.S.-centered, earnings are also linked globally. What you're betting on isn't Apple or Tesla. It's the growth of the global economy centered on the United States. Buffett's allocation: 90% stocks, 10% short-term government bonds. Do you understand the meaning of this 10%? The short-term bonds 10% is a safe asset cushion. Short-term bond yields change depending on interest rate levels. There are times of 0 rates and times of 5% rates. But the role is primarily resilience in downturns and liquidity. When the market crashes, this 10% protects you. It cushions the volatility of the 90% stocks and provides psychological reassurance. It prevents panic selling. This is the true value of the 10%. However, this allocation isn't for everyone. The optimal solution varies by age, risk tolerance, and goals. This is one example suited to Buffett's wife's situation. Beat the market. Attractive words. But after 15 years, about 88% fail. Become the market. It might sound boring, but this is the statistically proven winning method. Buffett's will shows it. Even the world's greatest investor recommends index funds to his wife. Why? He knows the futility of trying to beat the market. Not emotion, but math. Not intuition, but statistics. That's Buffett's philosophy. And that should be your philosophy. While low-cost diversified investing is generally powerful, asset allocation needs adjustment based on goals, age, risk tolerance, and tax considerations. Don't try to beat the market. Become the market. Just with that, you beat the vast majority of professionals. Now let's organize today's key points. Here's today's summary. First, the power of cost. 0.05% annually versus 1.5%. Just a 1.45% difference. But after 40 years, it creates an asset difference of about $895,000. Low cost is the certain advantage. Second, the defeat of professionals. Over 15 years, about 88% of active funds lose to the S&P 500. This is a statistical fact. As professionals compete against each other, they consistently lose by the amount of fees. Do you think you're better than professionals? The data says you're not. Third, the power of the market. In the long term, staying in the market is the path to victory. Even short-term winners eventually approach the average. So don't try to time the market. Stay in the market. What will you change starting today? Will you choose an ultra-low-cost S&P 500 index fund? Or will you walk the same path as about 88% of professionals? Share your strategy in the comments. Your questions, your plans, your decisions. Everything becomes the wisdom of this community. Thanks for investing your time with me today. This channel provides concrete strategies for index investing, asset allocation, and financial freedom explained with numbers. If you want to learn Buffett's philosophy and know how to beat the vast majority of professionals, subscribe to the channel. Turn on notifications too. Until next time.